I'm very pleased to welcome back to the show Ryan Irvine, Keystone Financial. Ryan, always great to get a chance to talk with you, and especially had a lot of interesting stuff. And I'll just give people a little preview. Ryan's got a couple of new recommendations for us. He's got a couple of reviews of past recommendations coming up in a minute. But first, and we've got to make time. I've got to make sure I get there. But Ryan, let me just start with this broader market right now. I mean, we've seen these big rises in the market post the December decline. You're a value investor. You look for situations that provide investors with a real opportunity because the market has mispriced them. They're cheap, in other words. What do you think of the market today?
Yeah, it's a great question. Thanks for having me on again. And I got to say, the Stairway of Heaven riff reminds me of a slow dancing back in grade 9, so it brings me back there. But as far as the markets generally, we do not find the markets cheap at present. And we find value-based, growth-based companies, and we find it hard-pressed to go out there and find our clients today 10 high-conviction stocks to buy. Mm-hmm. And in fact, I would not recommend that in any market, but right now, we think it's prudent to be cautious in one stock portfolio, and the markets are priced what we'd say is near to historic highs than lows. Yeah. So why do we know this? How do we see that in the market? We value, just like we value a stock based on its earnings and cash flow, the money it's producing, we value the market based on broadly on earnings, and you might use a PE multiple to do that. It's not perfect, but it's a way to value a company that measures its current share price to per share earnings. Now, it's the same concept with the entire market. You can give an idea. It can give you an idea of where the market is historically, whether it's cheap, expensive, or somewhere in the middle. We use something called the Shiller PE to do this from a historical perspective, because it eliminates some of the fluctuations, those wild spikes you can see in a crisis, for example, in the business cycle. But let's not make it too complicated. Let's just look where we are right now with the 500 largest stocks in the USA at present. Where is the Shiller PE? Well, it's at 31.1 right now. So its historical mean or average is 17. So right now we're 82.9% higher than its historical mean. Now, we're not at a historical high. The historical high was 44.2 in June 2009. That was during the financial crisis, but certainly on the higher end. Counteracting this is solid U.S. growth in earnings. So that multiple, your earnings multiple on the denominator there, is increasing. So it's bringing the PE down. But we're not blindly buying the market at present. Mm-hmm. Our solution would be, if you're going to look at value stocks, creating a portfolio, 10 to 20 stocks, that's what we like to do. Make sure you don't buy all those stocks right now. You spread your purchases out over a 10 to 18 month period. Use that strategy if there's a correction tomorrow, in 3 months, and 6 months from now. Maybe it doesn't occur, but if there is one, you're purchasing half or more of your portfolio at better prices. We think that is the best way to structure and start building your portfolio in these type of markets, particularly.
Well, speaking of that, by the way, you're doing a whole series of seminars coming up, which I think will be a great interest to people, because I love the foundational approach. Let's say, how do you start? How many stocks should you have in a portfolio? When should you acquire the stocks? All of that stuff. And just let people know that you're actually doing that coming up April 15th in Kelowna, April 16th, you're listening today in Victoria, April 17th in Langley, April 23rd in Vancouver, 24th in Edmonton, 25th in Calgary. My goodness. And then you're going back east. Why you do that, I don't know. Kitchener, May 7th. Toronto, May 8th, and Oakfield, May 9th. Bottom line, I think I could do that one a little better. Why don't you just go to MoneyTalks.net right there. You can click on and find out more about those seminars. But that's exactly the kind of thing that you're dealing with there. And let me just go back to what you guys do, you and Aaron Dunn. Whether it's in quality stocks, Aaron looks at quality stocks with a dividend yield. I love the way you always, because it's the first thing you should be doing. You always tell investors, okay, this is the risk you're taking here. Is it a moderate? Is it a higher? Is it a speculation? That kind of stuff. That's one of the first things that grabs me about KeyStone's approach to the markets, which I think is absolutely right on. So let me just, because I don't want to run short of time, because I get lynched if I do here. So give me a couple of updates that you've been recommending on the show, because I'm a big fan of the Boyd Group Income Fund. I mean, that's made people unreal amounts of money. I remember going back, I think it's about 10 or 11 years ago, you started recommending Boyd on Money Talks and in KeyStone's literature, the small cap review, at $2, I think $2.25, $2.50 in that range. And what did it close this week at? So I just want to give people a juxtaposition. $2.50. I remember you talking about it on Money Talks.
What's awesome is it's paid us $3.50 in dividends, so it's paid us back our investment. But I guess the best part is it closed at $148 today, and this is a stock that we've recommended literally the most initial buy recommendations over the past 10 years. It is the best performing stock on the entire TSX, so we're very happy with that.
Well, I was going to say they should put its picture under home run when you talk about
we need that, because you're not going to have that all the time. You can't. You need these type of companies in your portfolio. But I think we got looks. We recommended this company at the Outlook again 2 years ago when it was trading at $60. After you recommend a stock that trades at $60 and you bought at $2, people give you looks. But again, it goes to 148. Great company, really simple. Just operates collision repair companies in North America, which is a great business, solid. 19% revenue growth last year, 36% growth in adjusted earnings. We think it's worth $160 right now. I think it's higher end of valuations by a half position right at this point, but we can continue to buy a winner like this long term.
But again, just very quickly, because I know obviously you go into depth, and that's what people who buy your research and get stocks like this. But what is fascinating is there's a tendency for amateurs to not follow a stock up. Momentum traders may, but you sort of go. But one of the things you've done is say, stop. Well, let's look at it. Is it worth this valuation? Pick a number. As you say, 2 years ago at the Outlook, it was $60. For goodness sakes, recommended at $2.50 originally on Money Talks and through Keystone Financial. So there you go, $60, and you're going, are you recommending that still? But you go in and you look at it and saying, is it worth it? What's the future earnings? All of that. I just think it's important it's very tough for people to jump into a $60 stock when it's been $2.50.
It's very difficult. You have to look at it like you've looked at it the first time. That is very difficult to look back and say, I haven't looked at it all those years, but you really have to look at it. Every time we do an update, we look at it like we just found this company today. That's the way to value a stock.
That's a great. Okay, give us the other one. You're going to give us an update.
Yeah, it's VMed Healthcare, VMD on the TSX. We talked about it last fall. It was trading around $5 there at the Outlook, and to our clients the year before, $3.85. Yeah. Trades at $7 this week, so it's 40% up from the fall. Again, let's look at it right now. Like, we're just looking at this business today. What does it do? In layman's terms, they have therapists, respiratory therapists that go into a home, treat patients with sick lungs. Primary disease is COPD, or chronic obstruction pulmonary disease. Non-invasive vents is what they use. It's a better quality of life for the patients and saves the healthcare system. It checks a lot of boxes that we like. Revenues were up 40% last year to $65 million. Adjusted earnings up 44%. The balance sheet, great. Net cash position, $10.5 million, limited debt. How does this company grow? They grow through internally generated cash flow. They're not issuing more shares to dilute shareholders. They're funding the business through the money the business creates, essentially. Strong growth drivers going forward. The demographics are behind this company. Accelerated revenue growth guidance going forward, over 44% in the next quarter. We think it's worth $9.50 right now. It's trading around $7. That's 36% higher than it is now. That's only 12.5 times adjusted earnings, so it's growth at a reasonable price. I met with management this past week in New York. Really quality team. Just put their head down, run the business, do what needs to be done to grow the shareholder base, and they own a significant percentage of the shares, which is key. We like to have management aligned with us, and they are with this company.
Yeah, as I say, it's such an important thing to do, is to meet the management, see what the future is. And I'm proud to say that was one of our main recommendations going back in 2017 at the World Outlook. And, it's done 2018, I'm sorry. It has done incredibly well, when you look at that. And I mean, to be honest, Ryan, that's what you're about, but that's what we're about also, at the World Outlook. And that's why, in conjunction with Keystone Financial, we've worked on the small cap fund. And thanks to Ryan and Aaron, this thing has never failed to produce our small cap portfolio at the World Outlook, never failed to produce double digits returns over 10 years. It's incredible. And go to moneytalks.net. I don't have time to go through all of the different things that he's dealing with. His stock investment seminar coming up in all sorts of different locations, Kelowna, Victoria, Langley, Vancouver, Edmonton, Calgary. Check it all out. Go to moneytalks.net. Talk about everything you need to know, plus recommendations, whether it's you're building a tax-free savings account, whether it's an RSP or whether it's, of course, just in a normal portfolio. So go to moneytalks.net, check it out, because there's happening very soon here. Ryan, I said I'd put you on the spot, and we don't have a lot of time, but that's why people should subscribe to Keystone. But give us a couple of new recommendations.
Excellent. We'd like to give you some exposure to the U.S. market here. This is truly in our discovery area of research. Found this company 18 months ago when it traded on the OTC. It's graduated to the NASDAQ. Company's called Zynex Inc., ZYXI. Around 450, trades in that range. They design, manufacture, and market medical devices to treat chronic pain and acute pain and rehab. Electrotherapy is what they use, not like Dr. Ho's electric pads you see advertised on late-night TV. Don't picture that. We're talking about doctor-prescribed pain and rehab equipment that is used in place of highly addictive opioids. Opioid crisis in North America is a tremendous problem. These devices are safe alternatives, and it's one of the drivers of growth. Revenues were up 36% last year to $31 million. Net income up 30%. Great balance sheet, $10 million in cash in the bank, no debt. $20 million expected next year. That would be 14% of the whole market cap. 50% of the stock is owned by management. It paid a dividend last year. A special dividend yields about 1.5%. We expect that again this year. We see fair value in the $575 range, 25% higher than it is right now. That's just 15 times adjusted earnings, which the market trades well above that. So we think it's growth at a reasonable price, and it has a real growth tailwind ahead of it. We think it can really move forward in terms of its growth prospects. Adding salespeople, we like that. So the next company we'd look at is Aritzia. You got time for that?
Yes, we sure do.
ATZ is on the TSX. What do they do? It's a little it's a bit larger in terms of our small cap research, $2.1 billion in market cap. It's women's apparel, 68 boutiques in Canada, 24 in the U.S. I know that every time I go into this store, I leave with a lighter wallet. I have a wife, a daughter, a mother, and 4 sisters, so it's busy as all hell every time I go in, so I do like to see that. I typically hate retail stocks, but fashion, it can be fickle, so the markets don't like fickle, but Aritzia has really been hard to ignore. It's a great Canadian success story. It started here in Vancouver, growing revenues profitably from $153 million in 2008 to $753 million in 2018. I think it's impressive that this company has yet to close a single boutique or store in its 34-year history. A lot of retail companies we see closing them all the time. This company not doing it. They're doing a lot of things right. They're a cash-generating machine, strong net cash position in the company at the end of this year. Revenue we expect to grow 18% this year. Earnings up 20%. They execute great in 2 areas where Canadian retailers flounder. Online, 25% of the business in the next year and a half, and within the U.S., where you see expansion by Canadian companies go dismally all the time. This company is doing it right. They trade at 20 times, just under 20 times earnings, which is a discount to better-known peers in the market like Canada Goose and Lululemon, which trade at 40 and 33 times earnings. So we see this as a longer-term holding, 2 to 5 years, growth at a reasonable price, and we'll bet on Aritzia going forward.
Yeah, that's fascinating because, I know why wouldn't you be uncomfortable with fashion retail, as you say, but that's an incredible record, yet to close a single boutique in 34 years. Really interesting stuff. And the kind of thing that you're going to get a chance to talk more about, at the seminars that are coming up. And so just before you leave, I just want to remind people to go to moneytalks.net. Right there in the front page, you can see click on the DIY stock investment seminars. This is the kind of thing, I'm big on this, Ryan, and that's why we do the Outlook. That's why we support, with quality people like yourself, educating the public. Education is your key. And God, that sounds like a cliche, but that's also spoken from 40 years of experience for myself. That the more we learn, and you'll get a chance to go over, stocks. You're going to talk, in fact, about 5 stocks you should buy now. Look at dividend stocks, but also, the kind of growth stocks you've just alluded to. So I'd really invite people to go to moneytalks.net, check out keystocks.com. keystocks.com. And the thing I love, I don't know if you know this, we talked to your group and we're part of your people. You're going to give away the 100-plus page cannabis stock report, which I'm really happy you're doing to everyone who attends, because that's a huge area. As you know, we've been all over it since 2014, so another important one. Ryan, thank you for taking the time. Have a great weekend.
Thanks for having me on. We just want to simplify everybody's portfolio, save them a little money, and make them some money. Thanks a lot for having me on. Thanks a lot for having me on. Thanks a lot for